In what could be India's biggest IPO ever, Hyundai Motor India is planning to list in the markets later this year. Hyundai is India's second biggest automaker by sales and a unit of the third largest car maker in the world. It filed its initial listing document, or the DRHP, or the draft red herring prospectus, with the country's capital markets regulator SEBI late last week. The company is selling 17.5% or 142.2 million of its existing shares according to the prospectus, which means all the money goes to its parent. How much is it raising? Well, it hasn't made that disclosure yet, but it could be anywhere between 21,000 crore rupees to 25,000 crore rupees if you go by latest media reports. If it crosses the upper estimates, it may rival LIC's record 20,000 crore rupees debut in the stock markets 2 years back.
It indeed is a significant event for investors in general, and particularly those kind of investors would like to have better play in the Indian automobile industry.
I think the biggest opportunity for Hyundai today is its strong position in India.
Hyundai has been quite aggressive in their product strategy over the last few years, and they have been way ahead of market leader Maruti Suzuki in terms of introduction of new products, new technologies in India, and it has played out well for them.
Its valuations globally are quite suppressed. Perhaps India's IPO will give them that kicker in terms of overall valuations for the company. One of the material observations which goes against the company is that they paid themselves a dividend of almost 4,600 crore just prior to this IPO last year.
The biggest challenge Korean companies such as Hyundai has is the rising tensions, geopolitical tensions between China and the West.
So what is in this IPO for potential investors? Why is India becoming more and more important for the auto giant? What are its expansion plans globally and in India? Will its ambitious EV play yield dividends? Also, will this mega IPO by a global company in India make way for more? All this in today's episode. It's Tuesday, the 18th of June. From the Economic Times, I'm your host Anirban Chaudhary. This is the Morning Brief.
Well, Hyundai is a strong brand, a global brand, and it continues to be.
That's Felipe Munoz, global automotive analyst at intelligence firm Jato.
Because when you look at the other brands, the big ones such as Volkswagen, such as the Japanese or Ford, they are not that global, and their sales are concentrated in few regions. In the case of Hyundai, it has very good presence, not only at home in Korea, but also in the US or North America. In Europe, it has also a strong presence. Latin America, the Middle East, and lately in other African markets, and of course, Southeast Asia. So it's in terms of its position, of its global position, Hyundai is a strong one, is a strong player.
And yet, Hyundai's most enduring success story remains India.
I think the biggest opportunity for Hyundai today is its strong position in India. India is the world's fourth largest car market. It will be soon the third. And it's the only market from the top 10 that grows steadily. The US doesn't grow anymore. Europe doesn't grow anymore. And so you need other sources of growth. When you see the Hyundai's global sales by countries, well, of course, its largest one is the US. The second one is its home market, Korea, but the third one is India. And actually, its figures in India, its volume in India is not far from the Korean one. So it's almost at the same level of Korea. In Korea, they sold 610,000 cars last year, and in India, 602,000. So we're almost India is almost there.
Of course, seen another way, no other foreign automaker except Suzuki Motor has had the success that Hyundai has enjoyed in the Indian market.
All the others, the Americans, Ford, General Motors failed. Stellantis from Europe failed. Renault is struggling. Volkswagen with Skoda is not doing big things. So India is a very competitive and very difficult market for its own peculiarities. But Hyundai and Kia have been able to, to have a decent piece of the market, which is remarkable. Because when you go to India and you have to compete against Maruti Suzuki, which has around 40% market share, that's a big thing. That's a big problem because everybody wants to drive Maruti Suzuki and has a big presence in India. To fight that is not easy, and they have succeeded.
Hyundai was, along with Maruti Suzuki, the only car maker, local or international, to recognize the extent of India's nascent, massive demand for small passenger vehicles. That too in the early 90s. While it lagged Maruti's entry into the market by a good 16 years, it soon caught up and became a strong number 2. Hyundai's current vehicle portfolio in India includes 13 passenger car models across sedans, hatchbacks, SUVs, and battery-operated electric vehicles. Since its launch in 1998 till March 31, 2024, it sold 12 million passenger vehicles in India. It was also India's largest vehicle exporter from 2005 till the first 11 months of 2023. In fact, my colleague and ET's auto reporter Sharmishta Mukherjee says that in many cases, Hyundai has been more nimble-footed in responding to India's dynamic market than its closest rival.
Hyundai has been quite aggressive in their product strategy over the last few years, and they have been way ahead of market leader Maruti Suzuki in terms of introduction of new products, new technologies in India, and it has played out well for them. They were fast to recognize the changing preferences of customers here, and today they have a range of SUVs which a lot of other car makers in the Indian market couldn't bring on road. Like Maruti, for instance, only started introducing models last financial year. So Hyundai today has the Exter for entry customers. Then they have the Venue, the Creta, the Tucson, the Alcazar, and a couple of EV models as well, like the Kona Electric and Ioniq 5. And their agility has played out well for them. And today they're registering almost 67% of their sales from SUVs. And for a larger player like Maruti Suzuki, it is ranging between 20-23%. So there's this huge chunk of the market which they have been able to address well, and they have addressed fast, which has worked out in their favor.
Now, the post-COVID period saw rich Indians splurging on luxury items, from high-end phones to expensive holidays. Demand for premium cars also surged, and again, Hyundai was quick to respond by bringing in more high-end, expensive cars into the market. Between 2021 and 2023, its number of cars with an average selling price of over 10 lakh rupees grew from 32.37% as a chunk of total to 48.71%. It has increased even more to close to 50% in the first 9 months of FY24. Similarly, vehicles with average selling price higher than 15 lakh rupees have increased from just 7.45% as a chunk of total to 16% in the 9 months ended December 31st, 2023, or the first 9 months of this fiscal year. Another successful bet for Hyundai has been its Kia brand.
Kia has done quite well given the fact that they are a very new brand. They have established their positioning well,
Mm-hmm.
and that is also a strategy which has worked out well for the Hyundai group here, because for the longest time in the Indian market, there has been a huge gap in terms of volumes between the number one and the number two player. And while that gap still exists when you consider individual brands, between Hyundai and Kia, they managed to clock sales of nearly 8.5 lakh units in the last financial year, which has sort of narrowed the gap with Maruti, which sold around
Nice.
1.8 million units last year. So that is another way in which they have tried to address the market, and the two brand strategy has worked out well for them there as well.
Do we see other, Hyundai brands coming to India soon? Have they spoken about it, or have you heard anything?
Hyundai has a luxury brand called Genesis
Mm-hmm.
overseas, and they have been studying the market for launching this brand in India. Now, like they haven't officially commented, but they evaluation is underway as to when they could introduce these cars in the country.
Okay. So, Sharmishta, Hyundai has always been a large exporter of cars from India. It has exploited India really well in terms of exports. Has it fallen a little behind, maybe to cater to domestic demand, which has risen? And how is it sort of playing that balance, or restoring that balance between domestic sales and exports in the coming years?
In the last few years, because Hyundai has seen such strong demand for their products, they have had to, adjust the ratio between domestic sales and exports because their production capacity has been limited. They have only one plant so far in India, in Tamil Nadu, and they have been increasing production over there by undertaking efficiency measures, and today they can produce around 8,20,000 vehicles per annum there. But like given a car maker of their stature, they have taken their time to set up a new plant, so to say. And they recently kind of changed their stance on that front by acquiring the assets of General Motors in Talegaon. That would add around 2 lakh units to their production, and Hyundai in itself would have about a million units available to them, which would also help them, ramp up exports from India going ahead.
So, Hyundai has so far, as of December 31st, 2023, invested $298 billion in India. And this is since its inception. How does it look like in the next few years? What kind of investments will the company make? Where will those investments be allocated? Where do you see this going?
So Hyundai has made commitments to invest around 32,000 crores between Tamil Nadu and Maharashtra in the next 10 years. A lot of it would go towards bringing on road locally made electric vehicles and also establishing an ecosystem for these electric vehicles. Like they have
Hmm.
talked about setting up 485 charging stations by 2030.
Now, EVs are a global push for Hyundai. Last year, the company said it would be investing $50 billion at its home base in Korea to build three new factories to make 1.5 million electric vehicles every year. Here's Felipe again.
In terms of electric cars, Hyundai was the eighth largest car brand last year. And it was, of course, Asia's largest if we exclude the Chinese players. And these cars, they still represent a very small part of its global sales. We're talking of 6% last year, which is very low. And it's even lower than Volkswagen's, which is 8%. But it's higher than any other Japanese car brand. So the offer right now from Hyundai, we're talking of mainly three models: the Ioniq 5, the Ioniq 6, and the Kona Electric. They're doing very well, but we still need to see more electric Hyundais in the other markets, and this includes, of course, India.
In India, Hyundai sold just 1,635 EVs in the first 9 months of FY24, which was a mere 0.3% of its total domestic sales. But the future is very promising because India plays very well into the company's global EV manufacturing story. Here's how.
The Koreans in general, they have a competitive advantage that, for example, Europeans or Americans don't have, which is the access to these batteries. It has a strong battery industry, Korea, and it's actually becoming a source of battery components for car makers in the US after the IRA. So they definitely have an advantage. But still, when you compare them to what China is doing and how fast China is evolving, the Korean car makers, as part of a developed economy such as Korea, they don't have access to low cost labor force as the
Right.
Chinese makers have.
Right.
So this is why, for example, markets such as India become crucial, because there could be a potential development of electric cars in India, making use of the cheaper resources that India has in comparison to Korea, for example, or the US.
I asked Felipe and Sharmishta what they think are the operational challenges for Hyundai going forward. Here's Felipe.
In my opinion, the biggest challenge Korean companies such as Hyundai has is the rising tensions, geopolitical tensions between China and the West. Hyundai has a strong presence in the US, but it also needs China. So whatever happens in terms of geopolitics, it's going to have an impact on companies such as Hyundai. And so the challenge is to keep its operations running, of course, in China, but try to depend the least from Chinese components or any Chinese operations.
And here's Sharmishta.
One would, of course, be the increased competition in the SUV space. There are much more players in that segment today than when Hyundai had come out with the Creta. And there are many more products lined up from competition in the space. Also, while Hyundai is betting big on electrics going ahead, we have to watch out what the taxation structure would be on electrics in future. Right now, volumes are small, and the government can afford to give a GST of 5% on electric vehicles. But as volumes grow, and if this tax goes up, how it impacts affordability of electric cars, and therefore
Right.
sales in the market here would also be a key in continued success.
And then, of course, there's the Tata Group that has big plans in the EV space, from cars to batteries to charging infrastructure. Tata Motors has plans to invest between 16,000 crore and 18,000 crore rupees into its EV division until FY30. The company, which currently sells 4 electric car models, aims to launch 6 more by March 2026.
Tata has been breathing down their necks. Like last fiscal year, Hyundai had a share of around 14.5% in the passenger vehicle market in India, and Tata was close on their heels with a share of 13.8%. And both companies have new products lined up. They have outlined investment plans to expand capacity. So, Hyundai probably has to bring in more models and scale up volumes fast to extend their lead over Tata Motors going ahead.
Let's now come to what the IPO means for Indian investors. Hyundai India's financial numbers are robust. Its net profit for the year FY23 increased 1.6 times to 4,709 crore, according to numbers in its DRHP. For just the 9 months of this fiscal year, it has clocked a profit of 4,383 crore rupees. For more insights, I turned to Mahantesh Sabarad. Mahantesh is an independent analyst who spent 8 years in Tata Motors before being Vice President at Centrum Broking, Senior Vice President at Fortune Equity Brokers, and Head of Retail Research at SBI Securities.
When I looked at the financials from the DRHP, I find that it is quite true that this is a very well-run kind of company. You see that it's been growing quite steadily. Its revenue growth has been upwards of 15% for the past 3 years. In fact, an intermediate year, they did quite sharply better at 28%. Their EBITDA margins are quite healthy in the early double digits, somewhere around 11-12%. In fact, they have improved upon their EBITDA margins over the past few years. The ROC numbers are healthy. They have a very healthy balance sheet with almost half their balance sheet sized into cash or liquid instruments. And you also have a company which has presence in all the segments of the automobile industry in our country with a capex or a new plant that is coming up for them. So from a DRHP point of view, these are the 3-4 things that I would look at: strong growth, better, good margins, very well managed balance sheet, and upcoming capex to cater to the widening growth of Indian automobile industry.
Now, it's been raining IPOs this year. We've already seen 31 companies listing in the bourses since January and raising 28,520 crore rupees. There are 30 to 40 more IPOs coming up which will raise over 40,000 crore rupees, like Ola Electric, Swiggy, and Afcon. Now, this number does not count Hyundai, which of course is bigger than all of them. Mahantesh also told me that one huge incentive for Hyundai listing in India is the massive difference between the valuation it gets in its home markets now versus what it will enjoy here.
So if you look at the traditional multiples, the EV by EBITDA multiples, or even the P multiples, if I take P multiple for example, then the multiples that the Hyundai Motor Corporation in Korea gets in terms of valuation is in single digits. It's in low single digits. Whereas globally, some of the automobile manufacturers have very high single digit multiples, including the Japanese as well. With the Indian unit coming in, and if I were to hazard a guess what the valuation multiple could be for such a company, which is fairly large in size, profitable, has a legacy of well-run, all the aspects of a good company, strong balance sheet, etc., it should command a near similar multiple that we see from other automobile companies in India. So if I look at the ROC numbers that they have done for the last 2 years, it's in the range of 26%, 27%, and they are showing a promise of improvement. Although one should remember that as the EV portfolio starts growing, there would be a pressure on the overall profitability, and therefore the ROC could be potentially compromised.
Right.
But the way I see it, that dent in profitability or the dent in ROC coming from EV would hardly be 50 bips, 70 bips going forward. If that being the case, then the simple multiple that one could ascribe to such a company doing 26, 27% ROCs and having a great growth ahead could be in the range of 30 multiples plus or minus a few multiples here and there.
While on numbers, there's something in the DRHP that I wanted to clarify with Mahantesh. One thing that struck me, and it may be true of most global automakers in India, Hyundai localizes almost 90% of its models in India, but almost 33% of its expenses are transactions with the parent company. Do you think that's a concern going forward? that it has to
Yeah,
import
actually,
so much.
there's a dichotomy. Therefore, I don't agree with the first statement that you said that 90% localization is what they
That's
do.
its claim. Hmm.
That claim comes from a roundabout way of looking at things. Okay.
Hmm.
So here you have a company which has a lot of operations integrated, and that means a lot of parts and services that are procured from the parent and related entities, and it's not 33%. The DRHP reveals that number is closer to 40-45% in reality. Now,
Oh,
some of these parent based entities also have presence in India, and because they have a presence in India, Hyundai may be claiming we are 90% localized, while that necessarily is not true. So the correct way to look at is that the direct imports could be right when they say they are 90% localized. Direct imports would be 10%, while there are indirect imports that come from their related entities as well as other entities, which could be another 30%, 25, 30% more, taking the total to somewhere around 40-45%.
got it.
So I don't necessarily agree with this statement that says we are 90% localized. It is not the case. The level of transactions that they have is pretty high with respect to the parent. In fact, one of the material observations goes against the company is that they paid themselves a dividend of almost 4,600 crore last fiscal year, and now you will have an IPO which is entirely offer for sale, which will dilute the stake of Hyundai Motor Corporation by about 17.5%. And that's another, huge chunk of money that they will take back to Korea.
In fact, according to the DRHP, for FY24, Hyundai has proposed an even higher dividend amounting to a cash outflow of over 10,000 crore rupees. I asked Mohantesh if this is a concern for investors.
Not really. Okay. While this is something that they shouldn't have been doing, because for a company which is coming with an IPO, if I use the same multiples of 30 that I was talking about, then you will have a company which will have a market cap in the range of a lakh and a 50,000 crore to close to 2 lakh crores. If that's the valuation, mm, then 17 and a half of that would be a big 30,000 crore kind of number that they can take back home. Against the 30,000 crore, they shouldn't have really been rewarding themselves this 4,600 odd crore in the form of dividend. But to be fair to the company, they still leave the balance sheet with almost 15,000 crores of cash available for future use. Some of the future use is related to their own growth plans ahead in terms of capex, etc., and some of which can be usefully deployed to reward investors with another bout of dividends in the year ahead.
So you spoke about lower P's in the home market and very very healthy P's in India. One other company which is facing the same sort of a predicament is LG, and there is a buzz that it might also look for a listing in India. Just taking that into account, do you think this will pave the way for more MNC listings in India?
I think per se there has been this trend that suggests that a lot of MNC companies would like to list within India, considering that they have significant operations in India. So it does make sense to list locally. India is a very large market when it comes to stock market. It's not a small market. It has its own liquidity challenges per se, but it's fairly large. So for that means that a lot of foreign investors would like to also invest within India directly in the stock markets in India and partake the overall growth that can be seen from the companies that list. Most of the MNC companies in India run on a lean management, efficient capital utilization model and have distinct plans to grow with steady or market presence that's dominating. So all these attributes are to be found with Hyundai and are the attributes to be found with even an LG. So why wouldn't such companies list in India for better multiples? They can and they would.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Sarohini Jain and sound designed by Amrit Reggie. The Morning Brief drops every Tuesday to Friday on a listening platform of your choice. Do like, share and subscribe. And keep listening. Have a good rest of the week.